There were some fluctuations just before 2:30 p.m. Australian time. Okay, people were predicting a rate cut, rate rise, whatever. Am I right? So the rate was fluctuating quite a lot. Am I right? Especially a few minutes before 2:30 p.m. But after that, it was quite stable, and at the moment, a little bit trending down from what I checked before the lecture. But anyway, it is something in action that you might want to say. Okay, so clearly a good event for the Aussie dollar. Am I right? So people, not many. Okay, just a few people were predicting a rate cut, but clearly we have the budget night coming in a few hours as well. So people tend to wait for that. Okay, and if you are interested in the Aussie dollar, you might want to spend a little bit of time tonight, listen to the treasurer, okay, what he has to say for the coming year, where the money will be going in the between now and next year. Okay, so it's called budget night, as you know. And looking forward, in the next couple of days, we have some important numbers coming from the US, right? Unemployment rate, very, very important. Non-farm payrolls, those numbers, they are very, very important because they are the indicators of the US economy, and it is extremely, the market will follow those numbers very, very closely. Okay, so the first extra problem, this one, this is similar to our Pecunian economy, correct? So this question, the first extra problem, it is a banana republic economy, am I right? And it has got, so the information given to us, the country has a current account deficit of $2 billion and a non-reserve financial account surplus of $1.5 billion. Ignore net errors and omissions. First part of the question, what was the balance of payments of Banana Republic in that year? So if you add up this deficit and this surplus, am I right? You end up with $0.5 billion as a deficit, net deficit, correct? Net deficit. What does that mean? It means people in the country imported too much, correct? And somebody would need to make the payment. Am I right? And here we don't have any information about potential payments for the import. So the only chance is that the government, the central bank, would need to make corresponding transactions, correct? So there must be a surplus of exact amount, $500 million, $0.5 billion, through the reserve assets transaction, all right? Through the reserve assets transaction. So let me show the answers, and do let me know if you have any question about what you see here. So part A, the balance of payments is minus $500 million. Okay, that is the balance of payments in the media language. Okay, that number reflects what? The economic activities, international economic activities for the country, without the involvement of the central bank. Correct? Without the involvement of the central bank. And the central bank is in the position to balance out the net value. So part B assumes foreign central banks neither buy nor sell Banana Republic's assets. How did the central bank's foreign reserves change in that year? So obviously the only chance for us is a surplus 500 million, correct? Because in part A, we have a deficit 500. So now it is clearly the place for the central bank to record a surplus of $500 million. How does that happen? How can that happen? A surplus of $500 million. It means selling, right? Or exporting. So the central bank was, for this country, was exporting assets to the rest of the world. Make sense? That is the only way. Okay? It was exporting some assets or exporting some gold to the rest of the world to cover the deficit in Paris. All right, so in the answer, we say simply that the country's central bank's foreign reserves would need to reduce by that amount, $500 million. Okay, very simple one. Question? All good? Similar to what we discussed, right? The Pecunian story. All right, let's move on. So the next problem set is this one, and it is a very good one. So next week, when you see the past exam samples, you will see that we did have this kind of question, not the same one, but similar ones in the past. And given I'm not a fan of, deviation from the equilibrium, I will give the similar ones this time as well. Okay? So this kind of a question, make sure that you prepare well, because it's very likely you will see some versions, not the same, of course, of these questions in the exam. Question?
That the net errors and omissions are 0 instead of 0. If it is 1, then how do you...
Okay, so your friend's question, if getting back to problem set number 1. All right, so here we argue that the answer is based on the fact that we set aside net errors and omissions, am I right? And your friend's question is, what if we have to factor in some numbers within that particular category? Okay, let's say $100 million. Okay, that's a good question. And my only answer is that whatever number that you have in mind, just add that up. Okay, just add that up to the economy before you talk about the central bank. Okay, so here net errors and omissions. So we are in part A, right? And we assume that net errors and omissions are 0. So if we cannot set aside that figure, let's say it is $100 million, right? You just simply add that up to the sum, which is minus $500 million, okay? And then the rest, the new balance will be something for the central bank to do, okay? The central bank will deal with the net at the end of the day, including the net errors and omissions, okay? That's a good one. Okay? All right, and just to make things simple, am I right? If we stay with this kind of question for our coming exam, which is very likely, I will use the same setting, okay? So I'm going to use the Australian balance of payments to make it simple for everybody. Is that clear? So in learning, we can use any country. We can produce entries for any countries in the world. But for the purpose of assessment, let's make it simple. So I will stay, for example, with this paragraph, am I, of the question, because it's fantastic. I can't see anything to change, as long as I want the entries to be relevant for Australia, okay? So I will stay with this format, and then we have some stories, okay? It could be anything, hopefully some international transactions for Australian citizens, am I right? And maybe not. Maybe just completely pure domestic transactions, making things easier for you. Am I? Just say nothing to be recorded, and you get a full score, and you justify because it's domestic transactions. Am I right? Transaction between two domestic residents and involving no international assets. So nothing to do with the Australian balance of payments. You say no entry. Okay? No entry. Or we might have something like this, in which case you need to produce some entries, debits and credits, depending on what happens. All right? Always, like I said, think about the fundamental behind this setting. We have the double entry bookkeeping, and it's always the case that whenever we sell or export something, we have a credit entry, and then on the other side of the coin, we need to buy or import something, right? Just to counter our transaction, our position, correct? This is a transaction. It's an exchange of value for value, correct? So if you sell something, it must be true that you also buy something. Okay, you cannot buy without paying, correct? And likewise, you sell, other people need to pay you the same amount of money, okay? Now, let's go to the answer. The first story, an Australian firm engages a Norwegian shipping company to transport goods. The Norwegian firm is paid $1 million deposited in the Norwegian firm's bank account with ANZ Bank in Melbourne. So clearly here it is an import, right? Because the Australian, so from the Australian perspective, the Australian firm was buying something, right? Importing a service from a foreign company, correct? So the transaction is import. The nature of the transaction is import. Does that make sense? Okay. And the relevant subcategory would be what? This is, a shipping service. So it is part of services, right? Services. And what else? This is the amount you would need to put in your answer, because it's a certain amount. If you ignore the money, you won't get full score, okay? Because if we don't say anything about money, you don't have to put a number in. But as long as we show you the amount in Australian dollars, you would need to do the same. You would need to put that in your answer, right? In order to score a full mark for this question. So the payment is what? So the payment is such that the foreign company is paid the amount through deposit within ANZ Bank in Melbourne. So basically the foreign company has a bank account in Australia, and now that bank account receives the amount, okay? Receives that payment. All right? Funds transfer, for example. What does that mean? It means ANZ's liabilities to foreigners would need to increase, correct? Before, maybe the bank account has nothing, no money, okay? So ANZ's liabilities to foreigners would be zero. But now, because of these transfers, ANZ would be responsible for that. What it means at the end of the day, yes, is that the Norwegian firm can get back to ANZ anytime it wants and ask for the money, okay? It stays there, but basically it belongs to the foreign company. All right. So in the answer, so it's quite obvious. So we have import of services, and then payment is an export of liabilities, right? An increase. Don't say export of liabilities. Just say an increase of liabilities to foreigners. Correct? It's our language, as we talked last time. So we believe that a short answer like this, so we are with part A, right? Would be perfect for you to score the full mark for this question. So you say that there will be two, so the same way here, right? You just list two entries in the balance of payments. The first one being debit, and second one being credit, all right? And so the transactions, this one and that one, okay? The naming is not a big deal. Okay? You can name it whatever way you want, that you feel comfortable with. You can name, for example, hiring Norwegian shipping firm. You can name it in a different way. Okay? Import of shipping services, whatever. Am I right? As long as it works, we understand what you mean. That's it. Okay? So you don't have to follow the exact wording. Okay? You produce a name for yourself, which you're comfortable with. Make it short, don't make a very long name. We cannot read. Okay, make it short and easy to follow. Okay? And for the payment, the same. Change in deposits. If you don't like it, you can say payment. Why not? Am I? Payment. Payment for the shipping services, or simply payment. That's fine. Okay? Completely fine. And what's more important is that you make it clear. $1 million debit In the current account, subcategory services. Okay, that is for the credit entry. And for the debit one, it is the same amount in the capital and financial account, subcategory other investment. Okay, it is a loan. The nature of this loan or credits. Okay, the payment stays with the bank account. Its nature is loans or credits. So that will be to do with other investment in most of the case. The same if you use a credit card to make the payment, it can be also other investment. Okay, it's a loan credit within the bank account. Question? And the short note up there at the end of the answer, after the second entry, we explain why we have those transactions. Hiring the shipping firm is an import of services, and it should be a debit. And payment increases liabilities to foreigners, and it should be a credit. Okay. Now in the exam you don't need this thing, right? So that short note, as long as you have these two correctly presented, you will get a full score. Okay, you don't need to explain because you don't have time. In the exam, you have only 2 hours, right? You have to do so many things. So we used to have a 3-hour exam. That's why we have the notes. But from now on, you don't need to explain. Okay? So make sure that you have the correct entries and you get a full score. Now the note, if you are curious, you can still produce a note, something like this or along this line. So the benefit of producing a short note is that if your answer is incorrect, okay, it's incorrect, all right, then we will take a look at the note that you produce, and then we can give you some credit, okay, not full, of course, right, if your answer is not correct, so we cannot give you full credit, but we can give you some, right? That is our opportunity to give you some partial mark if your answer is incorrect. Okay, if your answer is incorrect and no short note, we cannot give you anything. Okay, we just give you 0 because everything is wrong, correct? But if you have a note, you explain things your way, and we kind of get where it went wrong, and then we can give you some partial mark. Okay. Any question? All good? So please do that. And part B. Okay. So like I said, let's go through these ones because. We tend to have this kind of question, a guarantee in the exam very much, okay, 99%. So let's go through some more examples, right? And so that in the exam you will feel very, very comfortable. You see, 4 and 4. Sorry, 2 and 2. Not 4 and 4. 2 questions in part A and 2 questions in part B. And they are very straightforward, so don't worry. Okay, good. Now, second story. An Australian resident sends a watch worth $250 to a nephew in Britain as a gift for his birthday. So it is sending something overseas, but without payment, right? It is an export without payment. So at best, the Australian resident might get a thanking letter from the boy. Okay, thank you for the gift. That's all. Nothing else. Okay, no payment because it's a gift. All right. What do we do? Oh, sorry. The ecstatic nephew writes a thanking letter for the watch. All right. So here we go. So part B, exporting, sending the watch overseas. It is clearly an export of something, right? An export of goods. So in the answer, the first entry, we make it clear it is a credit of $250 in the current account, subcategory goods, because it's a watch, right? It is a good. Clearly, it is commodity. It's not a service. Does that make sense? Credit, because it is similar to exporting, right? Sending something overseas, selling something to foreigners, right? Exporting something to foreigners. They are just the same thing. Good. And the payment, there's no payment. The fact that it is a gift is going to generate a debit of the same amount in the current account, subcategory, secondary income. or current transfers. It's up to you. Okay, if you're familiar with PBM5, you can make it current transfers. That's fine. Doesn't matter. Okay, because the nature here is a transfer, and it's not in the capital account because it's not money. Correct? If you migrate to a different country, bringing some funds with you, that will be recorded in the capital transfers. That in that area. Okay, but in this case, it is a good, right? So it will be part of the current account. Make sense? Good. That's 2 entries. And if you need to know why, just take a look at the note, this short note. All right. So it's where we explain why we have a credit and a debit. Okay, in the same current accounts, different categories, subcategories. Again, in the exam, you don't need to produce this short note. It is just for the purpose of backing up your answer. Okay, it won't add any value in case your answer is correct. So this short note is redundant. Okay, it's not necessary. Questions? All good? All right. So next one. Story number 3. An Australian resident has $1 million worth of funds in a bank in the US. So it is a holding of foreign assets, correct? The Australian resident is having some money overseas, right? In the US specifically. So he in his bank account in the foreign country, there are some money. Okay, that is the idea. The resident transfers these funds to a Swiss bank account in Switzerland. Okay, money transfers from his bank account to another bank account belonging to him as well. Okay, so do we have anything to record? Yes, right? Because this is foreign assets. Whenever you touch it, we need to record some entries in the balance of payments. Am I right? Even he transfers the money to himself. Okay? It is still one transaction. Why one transaction? Because the nature is that the funds, the money, is going from the US to Switzerland. Okay? So clearly something is changing, right? In terms of where the money is stored. Correct? So there will be entries for sure in the balance of payments. And because of that, we will need a debit and credit. Right? And how do we have debit or credit here? So funds transfer from the US to Switzerland. Okay, let's split it into 2 parts. Right? The first part is funds leaving the US. Okay, so basically the resident is having some money in the US, and now he decided to take them out. Okay, so so basically, if you want, you can think about the guy is cutting the holding of foreign assets. Okay, is cutting the holding of US assets. Correct? Because he's taking that out. It means his holding of US assets is lower. Does that make sense? It's lower. Lower, it means what? It's similar to selling or exporting, right? It is similar to selling or exporting because he is having $1 million. After that particular moment, nothing. Okay, bank account becomes 0. It means no money. Okay, so from $1 million down to 0. It means it is an export, a selling of assets. Okay, is the reduced holding of assets. So that particular reduction in foreign assets will give us a credit, right? It is an export of assets, so it is credit. The first entry will be credit, and we name it something like this: change in US deposits, or maybe you might want to say change in US assets, change in holding of US assets, whatever. Okay, or US assets. That's it. It's up to you. Okay. So this is important. $1 million credit in the capital and financial account, subcategory other investment. Okay? So deposits, loans, credits, they are part of other investment, right? And what's the second entry? Second entry is simply an increase in Swiss assets, correct? No, in this case, it's in foreign assets. Okay, it is liabilities from the Swiss point of view, but for the Australian resident, he is now having some assets in Switzerland, correct? Before in the US, now in Switzerland. So basically, he can get back to his bank account in Switzerland to take out the money. All right? So clearly, it's an increase in foreign assets, but now it is within Switzerland. Okay. So the second entry would be the same amount, debit, in capital and financial account, same subcategory. Okay, also loans and deposits, credits, so it's part of other investment. An explanation down there, as you can see, reduction in US deposits reduces foreign assets, and that should give rise to credit, whereas increase in Swiss deposits increases foreign assets back, right? And that is going to give us a debit, right? It is an import, a purchase of foreign assets, very much, okay? Selling US assets, buying Swiss assets, that kind of transaction. Okay? Any questions? No? All good. Almost there. Number 4. A Chinese firm borrows 500,000 Australian dollars from a bank in Australia. The bank deposits these funds into the Chinese firm's accounts with the bank. So what do we do? Borrowing money, meaning an increase in what? Liabilities to foreigners, okay? So that is going to give us what? Credit, am I? It is an increase in liabilities to foreigners. So it is going to be a credit, and the deposit of the funds into the Chinese account will give us a debit, correct? The corresponding debit. So change in deposit in this case will give us 500, the same amount, 500,000 Australian dollars credit in what? Capital and financial account, subcategory other investment. The reason being, as your friend explained, it is an increase in liabilities to foreigners. Okay, it is an increase in liabilities to foreigners. So basically, the money is in there, but it belongs to the Chinese firm. Okay, it belongs to the Chinese firm. So the Chinese firm can get back to the bank and request the amount anytime it wants. Correct? So it's similar. So that credit entry is similar to this one. To part A, okay, very much. Change in deposit, if you get back to this one, the bank, somebody deposits certain amount of money into the foreign company's bank accounts in Australia, okay? It is an increase in liabilities to foreigners, okay? So that, can you see that similarity? Okay, well, not to say exactly the same, right? The nature is the same. Somebody depositing money into a foreign residence or a foreign company's bank account in Australia. So that is going to give us a credit because it's an increase in liabilities to foreigners. Does that make sense? Okay, and the debit is from in this case, it is simply the borrowing by the Chinese firm. Okay, and the reason being what? It is an increase in foreign assets. Okay, why increase in foreign assets? Okay, so your friend is suggesting the borrowing by the Chinese company has a direct link to the amount of foreign assets we have. Okay, so let me make it a little bit sharper. So the idea is this: you borrow money. Okay, you have to sign a contract. Am I? You have to sign the paperwork confirming that it is the amount you borrow. Okay, and that paperwork serves as a payment in the future. You cannot borrow without paying, correct? At some point in the future, you need to make the payment. Does that make sense? Now, if you don't, what's going to happen? The Australian bank will go to China, okay, and show the paperwork to the company in China. Look, this is the amount of money you borrow. This is the amount of assets you borrow. Give that back to me. Am I right? So clearly, that contract, that borrowing arrangement is an increase in foreign assets. That is going to give the Australian bank certain amount of money in China. Okay? It deserves a claim on the Chinese firm in the future. So that is kind of idea. Okay? So there is an increase in foreign assets. All right. So just to wrap up, in this example number 4, when we have a foreign company to borrow money from Australia, it is an increase in foreign assets for the Australian bank, and the transaction, okay, is going to give you also a credit because of the liabilities, an increase in liabilities to foreigners, right? When the moment the fund is transferred to the foreign bank accounts, to the foreign company's bank accounts in Australia, that is the moment we have a credit, an increase in liabilities to foreigners. Okay? Is that okay? Good. So 2 entries, debit and credit. Okay? And it doesn't matter which one goes first. In this case, it's up to you. And finally, story number 5. An Australian firm purchases 20% of shares in a European steel manufacturing firm. The Australian firm pays for the shares using deposits it has in the bank in Munich, Germany. Okay, the Australian firm has money in Germany, and now it is using the money to buy what? Shares, right? Shares in a foreign company. Okay, so how does that happen? Buying. So clearly importing, right? Buying shares, and it is 20%. So you might want to justify. You might want to put that within the direct investment category, subcategory, right? Because it is 20%. More than 10%, you have the entry within direct investment. But I understand that in reality, right, that 20% might not give the company the voting right, in which case it is still portfolio investment, but we don't have the time to go into that details. So it's up to you here, okay? It's up to you completely. It's up to you where you want to put the entries within the balance of payments for the share purchase, okay? For the share purchase, 20%. You can put that in direct investment. If you say that, if what you have in mind is that it is more than 10% voting right, okay? Or if you don't like it, if you think that it's thin because of the European law, 20% is not going to give 10% voting right, okay? You put that as portfolio investment, that's fine. Not a big deal, okay? So here we give you just an example of the answer. We say that share purchase, right, or purchase of European shares, it is a debit in the Canadian financial account, subcategory direct investment, okay, direct investment. Don't worry, like I said in the exam, it can be portfolio investment, okay? This is for practice. Is that okay? Good. And the second entry is a credit, of course, right? The credit in the Canadian and financial account, subcategory other investment. And why credit? So look at the payment. So the Australian firm pays for the shares, okay, using deposit it has in a bank in Germany. So the Australian firm has some holding of foreign assets, correct? Okay, it has got some foreign assets, and now it is using some of the foreign assets it is holding to pay for the shares. Okay, so it is a reduction in foreign assets, correct? So when the company uses the deposits, it is clearly the case that the company will end up having less money overseas, right? In Germany, money will go down, correct? Bank account balance will go down. So it is a reduction in foreign assets. Does that make sense? And it is a selling of foreign assets. So reduction in foreign assets will give us a credit entry. So credit because of that, and if you are interested in the explanation, you can do something like this. All right. Any questions? No? All good? So prepare well for this. You will see some version of these things in the exam. Is that okay? Good. And you will have, this is a good practice, okay? And next week, when you see the past exam papers, you have a lot of more examples for you to practice how to record the entries, okay? How to produce the relevant entries within the Australian balance of payments again. So no drama. So as long as you're comfortable with this, it should be okay. All right. So let's move on. So last time we were okay. So just to jog your memory, last time we were talking about what? The demand-supply model of exchange rate determination. And the last factor, the last important factor is the central bank's intervention. And we already discussed this thing. Basically, this is when the exchange rate is fixed, the central bank will need to maintain the level as zero. It announced to the public, right? Because the central bank announced the exchange rate to the public, it had to defend the number no matter what. Okay, if the market wants a lot of foreign exchange, the central bank would need to provide the public with that amount. Okay, if demand is increasing, supply by the central bank will be increasing as well. So by doing so, the equilibrium exchange rate can be maintained. All right, and within the Bretton Woods system, central banks around the world, they had to do these things every day. Okay, they have to do a lot of transactions this way because they announced a fixed exchange rate. So the number cannot be changed. All right, so let's move on. We have speculation, market making, and arbitrage as the remainder of topic 2, part 3. So first one, speculation. So speculators, like we do for the purpose of the assignment, can buy and sell currencies. And the main objective is to make money, right? Is to make money. And in order to do that, we need to put in some expectations. We have to anticipate the future movements of currency values, all right? And then we can put in the relevant trades. Speculation can be destabilizing or stabilizing. Okay? There are two ways to speculate in the forex market. The first one is called destabilizing speculation. So what it means at the end of the day is that when you take a look at the currency markets, right, you see normally they have ups and downs, right? Peaks and troughs, correct? So normally in a normal environment, right? So this is suppose the time, okay, the time we're talking about. So we see a normal market in which in some period, right, the value is going up, and in other periods it is going down and back and down, okay, something like that. Over time, there's no monotone direction, correct? So currencies, exchange rates, they always like that, up and down, right? Monotone direction is a disaster, okay? Nobody likes one direction. So people want fluctuations, but not too much fluctuations, of course. Now, this is a normal market, no speculation. Okay, with the first one, right, we call destabilizing speculation. What it means is that whenever the rate is rising, okay, the value of a particular currency, let's say we have, this is the value AUD/USD, right? Suppose we are talking about the market for the US dollar. Okay, at the moment about 1.5, as you know, right? 1.4 something. So whenever the rate is going up, okay, if the rate is going up, because of speculation, people will tend to believe that it is not the end of the, of the uptrend, okay? Take a point here, for instance, right? At point 1, without speculation, so it's just a normal position in the marketplace, but with destabilizing speculation, people will think, or speculators will think, it is just a beginning, okay? It is the beginning of an upward trend, okay? It will continue for some time. It is what they believe, okay? So when the rate is going up, so people will think that it will continue to go up, okay? So it's time to make money. It's time to buy. It's not to sell. You see the point? So it's called destabilizing speculation, okay? Now, many people will think that way. So if we have destabilizing speculation like that, at point 1, many people will buy, okay? And because of that, the exchange rate will go up quicker, okay? Quicker. So you don't have to wait for 5 hours to get to point 1. Because many people, the moment the trend leads, the balance, this line, okay? This balance point, S0, okay? People will put in their expectation, right? And they will be buying. They will be buying. Everyone will be buying, and because of that, you don't need to wait 5 hours to get to point 1, okay? With speculation, the up will be a lot quicker because of the buying forces. So you will have something like this, okay? The trend, the actual trend with speculation will be a lot quicker, okay? You get to point 1 a lot quicker, okay? Because of speculation, right? George Soros kind of people, okay? They anticipate the value going up, they will be buying, and that will drive up the value a lot quicker. So with destabilizing speculation, you should expect the rate to go up by a lot, okay? By a lot, and very quick, okay? That is when people think it is the trend, okay? An uptrend. Now, when the rate is going down, people will think different way, okay? It is falling. It's time to sell because it is just a start of a downtrend, okay? So to the other side of the coin, right? If you are on the right of this mountain, okay, at the peak, the rate is falling, correct? So here, the rate is falling in a normal market. And speculators, they will think that it is the beginning, okay? It is beginning. So let's sell before it's too late, okay? Let's sell. Let's short the currency. Let's short the US dollar before it's too late. All right? So they will be selling a lot and very quick. All right? So with destabilizing speculation, you would expect the rate to go down very, very quickly. Okay? Skyrocket kind of speed. So the rate will be like this. Okay? Falling down very, very quickly. Very, very steep. Okay? So let me just wrap up. So without destabilizing speculation, the black line is the normal market. Fluctuations for that particular currency, the US dollar. With destabilizing speculation, it can be given by the red line, okay? Because whenever it's going up, the rate is going up, it can be very quick due to speculation. And whenever it is going down, it's also very quick because of speculation, okay? So up, a lot up, down, a lot down. And if you keep on with that discussion, you can draw a complete line, even in this area, you can have something like this, okay? So the red line is with destabilizing speculation. Is that okay? And the black line, which is the normal market, okay? I don't want to put it in because it's too many elements, so it's difficult to see. Okay, so that is destabilizing speculation, right? People tend to follow to make the rates move faster. So how about the opposite one, which is called stabilizing speculation? What do you think? Sorry. Should be this one. So stabilizing speculation is just the opposite. Okay, when the rate is going up, people will think that okay, it will come back. Okay, it will come back to the equilibrium value very quickly. Okay, when it's going up, it's time to sell because everyone knows it will go back. It is if it is 1.4, it is go up to 1.5. It's time to sell. Okay, because eventually it will go back to 1.4. Okay, that is a belief. If you have the so-called stabilizing speculation, people will think that way. Okay, if the rate is going up, time to sell before it's too late, right? Because it will go back down very soon. Make sense? Good. So, in terms of our drawing, what can we do in that case? All right, let's use the red color again. So the black line again, it is the normal market trend for the currency. Now with destabilizing speculation, whenever we go to point 1, okay, people will be selling. Speculators will be selling because they know eventually the rate will fall back down. Okay, they will be selling. So selling pressure will bring down the value, correct? So the equilibrium, they won't let the market to stay at point 1. Okay, it's too high. Many people will be selling, so they will bring down the trend. Okay, to around the equilibrium value. So with the so-called stabilizing speculation, you will observe the actual fluctuations to be around this value. Okay, people don't like fluctuations. Okay, whenever it is up, they sell. Whenever it's down, they buy because they know eventually it will go back up. All right. So with that argument, you can have something like this. Okay. So this is called with stabilizing. Okay, stabilizing speculation. Speculation. Okay. So at the end of the day, you have only two ways to speculate, right? You follow the market, push the price further up, further down, or you want to maintain equilibrium quicker, am I right? Whenever it's up, time to sell. Whenever it's down, time to buy. Am I right? If you believe that the equilibrium is 1.4, okay? If you believe that it will go back to equilibrium very, very quickly, it's time for you to do that. Okay. Now, so let me quickly show you another way. For the reference, you can also draw this thing, am I right? So in our drawing, right, US dollar. For instance, right, let's stay with the same market, and we have another one here. So this is quantity of US dollar, am I right? And we have equilibrium here. This is supply, demand for the dollars. Okay. Now, this is a normal market, right? We have equilibrium to be given by this point. And the exchange rate, again, it is S0. Okay. That is without speculation. We have equilibrium. And suppose, because of some changes, the exchange rate starts to go up the same way here, right? So we are going up to point 1. Let's talk about the destabilizing speculation first. Right? So if the market is such that people want the rate to be higher and higher over time, right? They keep buying and buying, right? Then we can have something like this. The starting point can be D1. So let's say it's D0, S0, right? So D1 can be something like this. That is starting point, and that is one way for you to push the rate to a little bit higher than equilibrium, right? And now what happens? Without speculation, It's just a normal market, am I? Eventually it will go back down, correct? But with destabilizing speculation, people will observe something is happening, am I? It is going up, time to buy, because it is just a starting, am I? It will continue to go up for some time, so it's time to buy. So because of speculation, speculators will make their move and they buy instead of sell. Right? They push the demand further up, am I? Or to the right. So the exchange rate will go up to this point, and because of speculation, it will be up further, right? To something like D2. Does that make sense? So without speculation, you end up with D1. But with destabilizing speculation, you end up with D2. Because people will be buying, observing the uptrend, okay? They will be buying. So one way, so this one and the top line, they are similar, stuff, right? So two different ways to look at the same problem, okay? To explain the same thing. And let me make it clear. So this is an example for destabilizing speculation. How about stabilizing speculation? So whenever you have D1, okay, suppose again because of some changes in the market, you have D1, okay. But remember now, in people's mind, in speculators' mind, it won't stay there long, okay. It will go back down to S0. One is not equilibrium, okay. It will go back down. So it's time to sell, right? It's time to sell because sooner or later the rate will go down. It won't stay there, okay? It's temporary, because in people's mind we have a long run equilibrium, right? We should stay near the equilibrium because now the environment is such that we have stabilizing speculation, right? Stabilizing. We want to stabilize everything. We want everything to be stable. So with that in mind, instead of pushing the demand curve further up, like this case, now speculators will be selling. Okay, so supply will change. They will sell a lot. They will, okay, if you want more of foreign exchange, I will sell that to you. Okay, so they will match with an increase in supply. Good. So that is exactly the point. So we shift the supply curve to the right or up, down in this case, right? To the right. It means down. So instead of this one, we will go back down. Okay? We'll go back down because people just believe in the long run equilibrium value only. Whenever it's above, they sell. Whenever it's below, they buy. Okay? So it's called stabilizing speculation. Just for the information, you might want to produce one of these figures in the exam if this is a question, and explanation is now very, very obvious. Destabilizing speculation drives exchange rate away from the equilibrium value, and stabilizing speculation is just opposite. It drives the exchange rate towards the equilibrium value. Okay, away and toward. Example from the Musa's textbook, the spot exchange rate between the Aussie dollar and the Swiss franc, CHF/AUD, is this one, 0.8580. So meaning the one Australian dollar can be traded for about 0.8 something Swiss francs, correct? So that is the exchange rate. A speculator believes that the Swiss franc will appreciate, so he buys 1 million Swiss francs. 2 days later, the exchange rate turns out to be this one, lower. Lower meaning what? The AUD is falling, meaning the Swiss franc is rising, correct? It's rising. So it's a good choice. It's a smart move, correct? He was buying Swiss franc and that currency was going up because this is the value of the Aussie dollar, right? The Aussie dollar is going down, meaning the Swiss franc is going up. Okay? Question, what will the speculator do? So a little bit vague, am I right? So I guess the idea is that that is the objective, right? Buying for 2 days, then what would happen, right? So it's time to take profit, correct? It's time to take profit. If he's aiming, the trader is aiming for 2 days, it's time to take profit. And how much profit will the speculator make? It depends on the difference, right, between here and there. And remember, this is the value of AUD, not Swiss franc. So the very first thing we need to do here is to figure out the value of the Swiss franc. It will make things transparent, right? So if you know the price of the orange you buy today and the price of the same orange after 2 days, right? Things easier. Then you are talking about the opposite, right? What is the value of one orange? Sorry, how much $1 can buy today and how much $1 can buy after 2 days? Very, very messy, correct? Very, very messy. So it's better to have everything in the same boat. So the first thing we do here so part A, right? We simply say that the Swiss francs appreciates, so the trader can take profit. And part B, in order to work out the amount of profit, it's better to start with this exchange rate, right? We need to work out this AUD/CHF exchange rate at the beginning and end of the trading period, okay? Or before and after. Is that okay? Before and after. So before, what do we have? 85 cents and 85.80, right? So we know the equation. 1 over these things will give us the value of the Swiss franc, correct? So 1 over this thing, because they have the reciprocal relationship. 1 over 0.8 will tell us the value of the Swiss franc, right? In terms of AUDs, correct? 1 over. So making use of that, we can first of all work out these numbers. So 1.1655 and 1.1755 is the exchange rate at the beginning of the period, and at the end of the period is 1.2 something, 1.21 something. Okay. You want me to show you how to get those numbers? No? Straightforward, right? Just 1 over these things and 1 over those things. Okay? And don't forget, 1 over the bit rate will give us the ask rate, and 1 over the ask rate will give us the bit rate. Okay? Just follow that rule. But I think it wouldn't take much time, so let me quickly, I just want to make sure that we are together on this exercise. So basically 0.85, okay? So let me make it bigger. So the value of the AUD, right? CHF/AUD is 0.8500, and then how much? 0.8558? No? Or 80? Good. You right? Oh, you cannot see. All right. So sorry about that. This technology thing. All right. So I have to move here and there all the time. Okay. Now it's clear, right? Good. So that is what given to us. So the first thing we need to find is the value of the Swiss franc, because the trader, the speculator, was trading the Swiss franc. So it's better to, of course, we can stay with the exchange rate. If you want to save time, if you're comfortable with what you do, that's fine. But if you're not very comfortable, it's better to convert the exchange rate into this one, right? 1 over what? Okay, 0.85 80. That is going to be the new bit rate. Okay? And the new offer rate is what? 1 over the first one. Good. 0.85. Okay? Any question about this? So do that in the exam, okay, if you have to. Right? So that is the starting point. Question?
The rate is coming 1.1764.
Okay, so not the same as mine? Alright, so that's fine. Things happen, okay? As long as they're not too far away, that's fine. Is that a completely different number? Or? Okay, so it's just a matter of calculating, all right? So we make mistakes from time to time. You cannot do that in the exam, but for the purpose of learning, okay? So it's an application. So do let me know if you have a completely different answer. But if it's a nearby number, that's fine, okay? So at the beginning of the period, the numbers, the value of the Swiss franc are given by this and that. And remember, the speculator was buying, correct? Buying those Swiss francs, 1 million from the bank. So which number was he paying? He was buying from the bank. So it has to be 1765, correct? So at the beginning of the period, effectively, the guy was buying at 1.1765. Okay? Now at the end of the period, what happens? The rate becomes this one. And the trader was selling back to the bank. Okay? Because when he squared the position, effectively he sold the amount back to the bank. Right? He was selling to the bank. The bank was buying. So the number is always this one. Right? It's a small number. So basically the difference between this, the offer rate at the beginning and the new bid rate would be the profit. Am I? Would be the profit. Because of the nature of the transaction. Okay, the bank buys at a low price and sells at a high price. So the profit is given by this one, about $31,000. Okay? Good. And if it happens during the trading game, if you can make this amount, that's fantastic. But you don't feel the pressure for it. Also, by the way, the balance from past trimesters, correct? The balance was around 42, 43 at the end of the trading period. So if you are losing money, that's fine. Okay, don't feel a lot of pressure to make money. Making money here is not easy, right? It's not easy. Okay, next part of the question. Suppose now there's a better deal for the trader. He can buy at the mid rate. He can buy and sell at the mid rates, right? Before and after. What would be the new profit? So if he has got a very good connection with the bank will allow the trader to make use of the mid rate instead of the bid and offer numbers. And we do the same, right? We figure out the midpoint exchange rate. So the average between the bid and offer numbers. Okay, and the same for the moment when the trader was selling. So basically, instead of using the difference between the offer rate and the bid rate, okay, now you use the difference between the two mid rates. Okay, the two mid rates. And here in our calculations, the mid rates become 1.2136 at the end of the period, the average between these two numbers, and the average at the beginning is what? 1710, okay, 1710. So the difference become a bit bigger, which is obvious, right? Because the trader is in a better position. He was able to buy at a lower price and sell at a little bit higher price. So that's why the profit is bigger than before. Okay? So comment. It's obvious that is a larger profit. Alright? Any questions? All good? Alright, so let's take a short break before we move on. So in the remainder of the lecture, I will cover exchange rate arbitrage, also important, and then I get back to the assignment and give you some tips. on. So the next thing for today will be arbitrage, right? And before that, I just want to make sure that we cover this discussion, market making. Okay, this one is a short one and fairly straightforward, I believe. Market making. So banks make the market, correct? Because they sell and buy in large volumes. They don't trade in small values. That's why they can make the market. And in topic 7, when we talk about the euro currency market, the LIBOR and that sort of business, you will see why. Okay, they trade in millions and billions. All right, so how does that happen? Now, to make profit, commercial banks, or we call them market makers, right? Large commercial banks, they buy currency at a low price and sell the currency at a high price. The difference being the bid-offer spread will be their profit. Okay, will be their profit. So that is what they do in order to make money. But at the end of the day, okay, the banks, they don't need money, correct? The demand is coming from people, not the bank. The bank doesn't need to buy food, clothes, education, right? But people, the demand is coming from people, from, individuals, business firms, correct? They need money to buy and sell things, correct? Not the bank. The bank doesn't need to eat, right? But they do. Why do they do this? Because they make money, okay? They know that me and you, we need to buy foreign exchange, but we cannot trade with one another, correct? Because it's very difficult. How can we figure out how much, for example, Japanese yen I want to buy and how much Japanese yen you want to sell, correct? It's very difficult. We cannot sit down to write that kind of contract, correct? So that's why all of us, we need to go to the bank. We tell the bank that, for example, me, right? If I go to Japan, I need to tell the bank I want to buy some Japanese yen, right? And if you have some Japanese yen, you sell them to the bank. If you don't need to keep that anymore, correct? You sell your Japanese yen to the bank. We don't know each other, unfortunately, so we cannot trade. We cannot avoid the bank's fees, right? So that's how banks do business. They make money that way. We still need them. And in fact, if you think about the story that way, right? One way to think about the demand for currency, right, is that, think about my case, right? I need to buy a foreign currency. I tell the bank, I want to buy this amount of foreign currency, okay? And I'm happy to pay this price. Does that make sense? I tell the bank, I want to buy some Japanese yen, maybe 2 million Japanese yen. Okay, I'm happy to pay if the exchange rate is 0.14, for example. Okay, it's what I can tell the bank. Make sense? And what would the bank do? The bank will, of course, they say yes. Okay, the bank will run the service. They will find a customer who wants to sell Japanese yen, correct? And then they match the order. That is what they do at the end of the day, all right, to make money. However, the difference is this. The bank is going to tell their clients a different story, all right? I just want to make it clear. So suppose this is a foreign exchange, all right? Let's say we stay with the general setting. We can have any foreign currency. And the exchange rate is D/F. Okay, this is a demand by customers. Right, suppose this is my demand for foreign exchange, and I tell the bank, it depends on the price, on the exchange rate. I'm happy to buy, 1 million units of foreign currency if the exchange rate is that. Alright, so for example, exchange rate is S0. I'm very happy to buy quantity Q0. Okay, if the exchange rate is S0. Does that make sense? And if the exchange rate is a little bit lower, I'm happy to buy more. Okay, I buy Q1, for example, right? It depends on how much the exchange rate is available. I will change the quantity I want. Right? I don't have to stick with one number, right? I tell the bank everything. Okay, if the exchange rate is high, I buy a little bit. If the exchange is low, I buy a lot. Okay, Can you do it for me? Is what I want. I inform the bank, and the bank will say yes. Okay, it's easy. We have customers who want to sell that foreign exchange, so we can do that for you. But like I said, what the bank is going to tell his network is a different story. Okay, I have the demand for currency F. Do you want to sell them to me? If the exchange rate is S0, right? My demand, so the demand for the bank, right? So I'm happy to pay you a little bit less. So the idea, let me put a number in, right? For example, this one is 1.1, okay? 1.1, meaning 1.1D will be equivalent to 1F, okay? 1.1. And now the bank is going to tell his network, I have the demand for this currency. And the price, I'm happy to, so let's say this is 1 million, right? 1 million. I'm happy to buy 1 million units of currency F at the price of what? Not 1.1. I want to make money, am I? I hide that information, okay? But I'm going to tell my network, I'm looking to buy 1 million units of currency F at the price of 1. Okay, it's what the bank does in order to make money. So why 1 but not 1.1? The reason is the bank will then sell that amount to me, am I right? Because I'm happy to pay 1.1, but I don't know who is selling in the market. So I have to approach the bank and I tell the bank, I'm looking to buy 1 million units of currency F at the price of 1.1. And the bank is searching, is telling the network who is selling 1 million units of currency F at the price of 1. Come back to me, okay? The bank is going to collect that and sell them out to me at 1.1. Can you see that? So the bank is going to make some money, right? They make a small profit from buying this amount for me on my behalf. Okay? So one way to think about that is to translate the demand facing customers into the demand facing the bank. Okay? Because like I said, at the end of the day, the bank will do everything on behalf of the customers. Okay? So effectively the demand curve facing customers will become the demand curve facing the bank, but at a lower price everywhere. You know? Because the bank will make profit no matter how much the price is, the bank is going to make money. So along that line, you can produce the new demand curve. You say that it is a demand curve facing market makers. Okay? So effectively, the market makers translate what? The demand curve facing customers into their demand curve. Okay? And it is everywhere lower. Can you see that? And the reason being, the bank will need to make money. Okay? That difference is the bank's profit. Does that make sense? For example, at that quantity, like 1 million units of currency F, the profit for the bank will be this one, 0.1. Okay? And it here, right? It is still a small distance, but it cannot be 0. Okay? That is my point. Because the bank will never do things for free. They will charge a small amount. Okay? They need to make money. Otherwise, how can they survive? Alright, so the red curve is called the demand curve facing or for the market makers. Is that okay for everyone? So if we need to buy currencies, right, a particular currency, we approach the bank and the bank will buy the currency for us. Okay? But they will search for that amount at a lower price so that they can make money. Alright, how about selling? Suppose now instead of buying, we have currency F and we want the bank to sell them for us. What do you think? So selling is different, right? So if we have currency F, this is our supply curve All right. So what's going to happen? We want to sell a certain amount of foreign exchange, but the problem is we don't know who would need to buy that amount. All right? Let's say $1 million. Sorry, 1 million units of currency F again at the price of S0. 1 million, right? Q0. So if this is the case, what do you think? We need to approach the bank again and tell the bank, I want to buy 1 million units of currency F at the price of, I want to sell this one at the price of 0.9, for example. Am I? 0.9? 0.9. Okay. What do you think the bank would do? The bank will search through the network, all right? Search for the buyers of that amount, but the bank is going to tell the buyer it's not 0.9, okay? If you want to buy, you need 1, or maybe 1.1, or maybe 0.95, something like that, okay? The bank will tell the potential buyers that I have 1 million units of currency F, and I'm happy to sell at 1, not 0.9, okay? So the bank will pass on the amount from me as a seller to the potential buyers that way, all right? So, and the bank is going to ask for a little bit more so that they can make money. Make sense? So effectively the same amount will be passed on by the bank to the potential buyers at a higher price. Okay, at a higher price. And that will happen everywhere. It doesn't matter 1 million or 2 million or maybe 100,000, okay? Anywhere, the bank is going to charge a little bit higher, okay? So that is the way for them to run the service. So the supply curve, if you think along that line, you can translate the supply curve facing customers. Sorry, let me make it clear. Customers into the supply curve facing the bank, okay? And it is clearly everywhere above the supply curve facing customers, right? Because the bank is going to charge potential buyers a little bit more. So demand side, the demand curve is everywhere below the demand curve. Sorry, the demand curve facing market makers is everywhere below the demand curve facing customers. All right? Supply side opposite. Supply curve facing market makers everywhere above the supply curve facing customers. All right? So at the end of the day, the message is that the bank is in a position to sell and buy on behalf of buyers and sellers. Okay? On behalf of customers. Good. Now, if you put these things together, right, what do we see? So, get back to lecture slides. So, this is some conclusion. I get back to that in a second. Now, if you put supply and demand sides together in the same framework, here is what you see, right? So, supply side, the supply curve for market makers is everywhere above. The demand curve for market makers is everywhere below the corresponding curves for customers. Is that clear? Good. So, if you look at this one, things will be transparent, okay? Because we have the two rates, the bit rate and the ask rate. The bit rate is the lower intersection. It is an intersection between the demand curve facing market makers and the supply curve facing customers. And it makes sense, right? It is the equilibrium at which people are happy to sell money, to sell currency to the bank. The price will be low, okay? The price will be low. And we have another intersection a little bit higher up there. It is where we have the demand curve facing customers, people are happy to buy, and the supply curve facing the bank. So people are buying from the bank, so the price will be high, okay? So the lower intersection, it is where people are buying this currency F from the bank. And the higher intersection, the higher exchange rate is where people are buying from the bank, okay? And that's why we have the bid offer exchange rates and the spread, as we have seen, right? So this is summary, correct? So the supply and demand, this is the summary of demand curve and supply curve that we have discussed. The demand curve is everywhere below and the supply curve is everywhere above. Just keep that in mind. And when you put things together, we have the bid rate and the offer rate or the ask rate. Okay? Question? All good? So in topic 7, we get back to some version of this when we discuss the LIBOR interest rate. Okay? LIBOR will be determined in a similar way like this, but a little bit more sophisticated because we have banks trading with banks. In the case of LIBOR, okay, we have first tier banks, second tier banks, and even third tier banks, right? And we see the LIBOR arrangement, but it could be similar to this. This is a starting point, very good starting point. Okay, and the last thing for today, currency arbitrage. So arbitrage has many forms, correct? And next time when we do topic 3, we have basically interest rate arbitrage in the international markets, right? But this discussion is not about interest rates, okay? It's all about the opportunity concerning the static exchange rates, right? Static exchange rates. So arbitrage is defined as simply the act of simultaneously buying and selling the same or equivalent assets or commodities for the purpose of making certain guaranteed profits. So what does it mean? It means if you have an arbitrage opportunity, you can make certain amount of money without any risk, okay? It is guaranteed profit, no risk, completely no risk. So what it means at the end of the day is that you see the two different prices, right? Two different prices, and you are free to do anything. Then basically you can buy at the low price and sell at high price, and then you can make what we call an arbitrage profit, and no risk at all because you can do that at the same time, right? You can trade the same amount at the same time, so no risk. Now in the forex market, currency arbitrage will involve buying and selling of currencies. Right? You need to buy some currencies and sell some other currencies. That kind of idea. So how does that work? And in practice, as long as you have arbitrage activities, the equilibrium exchange rate will be restored very quickly. So why quickly?
One side is buying and one side is selling.
Yes. So if buying and selling, they keep going, profits will be bigger and bigger, right? So eventually, it will end up with zero profit, okay? Because buying and selling. So the idea is that if you can do it, why can't I do it? Correct? Because it's free for everybody. If you can make guaranteed profit, I can do the exact thing to make a guaranteed profit as well. So clearly, everybody is going to do that. So that's why when we observe arbitrage opportunities, the equilibrium exchange rate will be restored very quickly. So you won't expect that opportunity to last long, okay? Because people will act very, very quickly. Now this is a very easy example. Suppose you observe this exchange rate, AUD/USD. So again, it is the value of 1 USD, right? It's the value of 1 USD. It is 1.2 Australian dollars in Sydney and 1.21 in Melbourne. So what would you do if you observe these things? Suppose you have access to funds, right? To make money, you simply buy in Sydney and sell in Melbourne. And what do you buy? That commodity, right? That the things that has got those prices, the US dollar, okay, the US dollars. So you only need to do to make money is to observe that US dollar is more expensive in Melbourne than in Sydney. So all we can do on arbitrages would simply buy USD in Sydney and sell them immediately or at the same time in Melbourne, right? And they can make guaranteed profit 1 cent per US dollar. Okay, 1 cent per US dollar. And no risk. It is free money. And eventually, because of arbitrage, we know that the equilibrium exchange rate between the two cities will be established very quickly. Am I? Now, when you have only two currencies, like this example, we are talking about what we call two currency arbitrage. Am I? So that's a very simple name. Why two? Because we have two currencies. Only one exchange rate, and that has got two currencies in it. So that's why it's called 2-point arbitrage or two currency arbitrage. Same thing, right? So if you have more currencies, right, 3 currencies, it will have 3 currency arbitrage or 3 points arbitrage. If you have 4 currencies, it will be so on. Okay? So we don't go along that line. We just stop with 3 points. So don't worry. Okay. So now from time to time, right, one exchange rate or 2 currency arbitrage is very rare, right? Because like I said, the opportunity will not last long. But from time to time, you might find opportunity through the connections of the intermediate currency. Right? For example, you have 3 currencies, X, Y, and Z. Okay, X, Y, and Z. And we know in equilibrium, right, from the cross exchange rate discussion, we know that in equilibrium, it must be true that exchange rate X/Y is the same as exchange rate X/Z divided by exchange rate Y/Z. Correct? That is a cross exchange rate equation. Now, in reality, sometimes it may not hold. Okay, meaning something is not right. Okay, it means what? There is an opportunity to make money. Okay, as long as you put the values in this formula, you have 3 numbers, right? And the equation does not hold. It means there's an opportunity to make money and risk-free profit, right? Good. So just stay with this simplest example. We have 3 currencies here: Australian dollar, Japanese yen, and US dollar. And suppose we know these 3 exchange rates. Okay, can you verify that the cross exchange rate equation is actually not working here? Can you? If you put the numbers in, right? I already put the numbers in a good order. So left hand side, Japanese yen / AUD is what? Is 75. Right hand side, what do you have? You have 90 divided by 1.5, which is 60. 60. Right hand side, 60. Left hand side, 75. Clearly, the equality does not hold. It means we have an opportunity to make money, correct? So we can play with the currencies in certain way so that we can make money. So in this case, before we proceed to money making, we have definition. So this, if you have 3 currencies and 3 exchange rates presented that way, we are talking about an opportunity for the so-called 3-point arbitrage, 3 currency arbitrage, or triangular arbitrage. Same thing, okay? So I just want to quickly show you at the end of the day, so this is what we can produce, right? At the very end of the day, we can make up the 3 currencies in the corners of a triangle. And then we can go certain way, right, around the corners, clockwise or anti-clockwise. It depends on what happens, okay? And the idea is that when we travel and when we get back to where we came from, we end up with more money. Okay, so that is good. That's good direction, correct? And if you end up with less money, you end up with the wrong direction. You should go the other way around. Okay. So anyway, so don't worry. We get back to that very soon. All right. Now in this case, if we put the numbers in, we know that left hand side 75, right hand side 60. So left hand side is larger than right hand side. Okay. So what should we do? So there are two ways to travel. Okay. This way or that way. Okay. We go around the corners of the triangle in certain direction, am I right? And see what happens. And if it doesn't work, we go the other way around. Okay. One of them should give us a lot of money. Am I right? One of them will be a disaster. Okay. And let's see what happens here. So because I don't know the formula, so for now I just show you both ways. Okay. And let's see what happens. Suppose I start with Japanese yen. I don't have to start with Japanese yen. I can start with, let's say, 1,000 US dollars. It doesn't matter. Okay. As long as you go certain direction and then you come back to where you came from. So that is the logic. So the first option is that I go in that sequence. I follow that sequence. Right? I go from Japanese yen to AUD, and then to USD, and finally back to Japanese yen. And my expectation is that if I start with 90 Japanese yens, I will end up with more than 90 Japanese yens, and I'm done. Correct? So that is a good way to go, good direction to go. Does that make sense? Okay. Unfortunately, if you follow this direction, can you see that based on my calculations, which you can verify at home, I end up with less than 90 Japanese yens. The reason is, it is a dead end. Okay? It's the wrong direction. I should not do this. Correct? So when I have 90 Japanese yens, I should not convert my Japanese yens into Australian dollars, and then into USD, finally back into Japanese yen. I should not do that. I should do the opposite way. Okay? So the second option is not going from Japanese yen to AUD, but to what? USD. Okay? So if you follow the second option or second sequence, you will see that 90 Japanese yens can be converted into more than 90 Japanese yens. Alright? It just follows this sequence, Japanese yen into USD, and into AUD, and finally back into Japanese yens. You will see that it is more than 112 Japanese yens. So fantastic direction, correct? This is a good business, because give me 90 Japanese yens, I can show you a way to make a little bit of money. Okay? I follow that sequence and I produce some profits. Okay? Now if we have a lot of money, we have access to a lot of funds, we can make a lot of money, right? By doing, following this sequence. Alright. So at the end of the day, right? We don't have time to do this. Show both options, right? It's boring, correct? So is there a shortcut in which I know immediately which direction to go? And this is my answer, okay? So if the left hand side, if you put the currencies in that correct order, and left hand side, that is our order, okay? X, Y, XZ, YZ is our order. And if you put the currencies correctly in that order, and if you end up with the left hand side being larger than the right hand side, the exact example is just this one, right? Left hand side is larger, correct? Then, if you start with Japanese yen, you don't go to AUD. If you start with X, you don't go to Y. You go from X to Z. Here, right? X to Z. That is the direction to make money. Does that make sense? If you go from X to Y, you end up with a loss. So if left hand side is larger than right hand side, you go from X to Z, okay? And then you know the rest, right? After that is Y and back into X, okay? So that is my conclusion. So left hand side larger than right hand side, you go from X to Z, to y and back into z. Sorry, into x. Okay. And we call this one the profitable sequence. So in the exam, you might be asked, what is a profitable sequence? And just show this one. Okay. You don't need to prove. Just show. It's from the lecture. Okay. We don't have time to prove everything. Correct. So this is the take-home message. Just for your reference. So in the exam, for example, if you are given the 3 exchange rates and you ask to calculate the arbitrage profit, so you start with the profitable sequence and it is given by this formula. Now what if the left hand side is smaller than the right hand side? We have the opposite, right? If left hand side is smaller than the right hand side, we go in the normal way, x to y to z and then back to x. Okay, x, y, z, x. But make sure you put the currencies in the correct order before you can apply. Now, the bottom line is if you are confused, am I? In the exam, for example, if you are confused, try both ways, okay, and show the profitable way. That's it. Does it make sense? Good. So you will have enough time to do that, so don't worry. But if you need a shortcut, then just do that. Now, from time to time, you might have the equality to hold, in which case you say what? Well, if left hand side is the same as right hand side, nothing to do, correct? You can't do anything to make money, right? No way. We call that a no arbitrage condition, because you cannot do anything to make free money, okay? There's nothing to do. Okay, and again, eventually because of arbitrage activities, the no arbitrage condition will happen very, very quickly. Okay, same reason. Okay, if you can make money, I can do the same, and our friend can also do that as well. All right, and if you think that putting the currencies in the corners of a triangle would make it easier to understand, then just go. This is from the text, right? So you can just follow that direction. So it's similar to what we do. So the left hand side is larger than right hand side. So right hand side, remember, our right hand side is exchange rate x slash z divided by exchange rate y slash z. Right? It is the same. If you do a little bit of change, the right hand side will become x slash z times z slash y. Okay, because why so? 1 over exchange rate y slash z is simply exchange rate z slash y. Okay, it's just the inverse reciprocal relationship if you want. But I would prefer, the ratio method. It's easier to understand. The product method, if you're comfortable, that's fine. But I find that the ratio is helping me more because I know the cross exchange rate equation. So I can use this first half. I can memorize the first half. Okay, good. So this is the case for left hand side being larger than right hand side. Then, like I said, you go from x to z to y and then x, right? And the opposite case is when you have left hand side being smaller than the right hand side, you go from x to y to z and then back to x. Okay? Then we call those things the profitable sequence. So in the exam, if you ask to show the profitable sequence, don't have to show everything, right? Just pick up the one that is going to give you profits. Don't show both. Okay? Just give the sequence, right? Based on the workout, just present the sequence that will lead you to some profits. Is that okay? Good. So I believe that it is the end of arbitrage discussion, and let me quickly go through the problem set because I want to start topic 3 next time in a fresh manner. So topic 2 part 3, we have a problem set as well, and we have chapter 5 problems 11 and 12. Please take a look at home. Now the extra problems, we have 2 examples for what we call 3-point arbitrage. Again, so this is an opportunity to practice what we have learned. Okay? And because they are similar, so let me just pick up one of those. So let's do the first one, shall we? Just one of them, okay? And you can take a look because they're similar. So as long as you can do the first, you can solve the first problem, you can do the second one in a similar way. Now remember, at the end of the day, you have three currencies, three exchange rates, correct? So what do you need to put for left hand side and what for the right hand side? So my quick answer, it doesn't matter, okay? As long as you can name one of the currencies as X, one of the currencies as Y, and the last one as Z. You just stay with our method. It doesn't matter which one being X, which one being Y, okay? Which one being Z. It doesn't matter, okay? So, but my advice is to, well, of course, we gotta be strategic a bit, right? Save time a bit. Look, let's say we do HR problem 1. What do we see? The second and the third exchange rates, right? They are in the form of something /USD, correct? So it's probably convenient to make them in the right hand side, correct? Because they are both in the format of something /USD. Remember in our lecture equation, we have this one, right? So right hand side is always something /Z divided by something /Z as well, correct? So it's probably convenient, right? If we want to save time, we pick up the exchange rate in this direction, so we can save some time. So for example, I would make this one my left hand side, okay? And the other two, my right hand side. And I try to fit my left hand side fraction, the next two exchange rates, I try to fit my equation, okay? Because I fix my left hand side, so meaning it is my X/Y, okay? If I pick up NZ $/AUD, that is my X/Y, okay? So my right hand side will be X/Z divided by Y/Z, correct? So if I do that, things will be very easy, okay? I save a lot of time. So let me show you the solution. So like I said, right, it's convenient to stay with that choice, and we can show, you don't have to, of course, correct? You can put any exchange rate on the left hand side, and then you match the right hand side with the left hand side. But here it's just for convenience, and we can show quickly that right hand side is too big, okay, right hand side too big. Left hand side is given by the question, it is 1.1625 given by the question. 1.1625 is given, and right hand side is 1.28 divided by 1.1 something, right? And it is 1.1678, too big. So left hand side is now smaller, okay? Left hand side smaller. So what is the profitable sequence? We go from X to Y to Z and then back to X. So we can quickly say, because left hand side is smaller, the profitable sequence is simply NZ dollar, AUD, USD, and finally NZ dollar. Okay? So that is the profitable sequence. The question, is there a possibility for 3-point arbitrage? If so, what is the profitable sequence? If a trader has access to 1 million Australian dollars for this purpose, how much profit will he make? What do we say? So first of all, because the no arbitrage condition is violated, right? Clearly violated because left hand side is smaller, right? Smaller than right hand side. We say that we will have an opportunity for 3-point arbitrage, okay? Because if the equality holds, we don't have the opportunity. But as long as it's greater than or smaller than, we have opportunity for arbitrage, okay? So, the first response, there will be a possibility for 3-point arbitrage. The profitable sequence is given by this one, and then we need to work out the profit, okay? And the question states explicitly, you have to start with 1 million Australian dollars. 1 million Australian dollars. So where is Australia? Where is Australian dollar in our sequence? Here, right? So if somebody gives you 1 million Australian dollars, what do you need to do to make money here? You just keep on with our sequence, right? You don't go from Australian dollar to New Zealand dollar. You just keep on in following that sequence. So you go from Australian dollar to US dollar, right? Because this sequence is profitable no matter where you start with, okay? It doesn't matter NZ dollar, AUD or even USD, okay? It doesn't matter where you start with, as long as you start from a currency, you come back to the same currency, that's it, okay? So you can start from AUD or even USD, NZ dollar, doesn't matter, as long as you keep going in that direction, okay? And here the question asks you to start with AUD, so just go this way, you convert AUD into US dollar, okay, and then whatever US dollars you have into NZ dollars. Finally, that NZ dollars will be converted into back into AUD, and you can see that starting with $1 million, you can end up with a lot more, okay. Oh, so the profit is 4,000. So there shouldn't be a 1 here. Alright, so forget about this 1. This should be 0. Sorry about that. Okay, I will correct that. Is that okay? So that is the profit. So the difference between $1 million and what you end up with. Of course, it should be more than $1 million. Okay, you cannot end up with 900 something. It is the wrong sequence. It's the wrong direction. You should go the other way around. Okay. All right. So that is the problem set. Now, the next part of this question: how do the three exchange rates, as mentioned above, change as a result of arbitrage? What do you think? So, if people give you AUDs, you immediately convert AUDs into US dollars. What does that mean? The demand to sell AUD by US dollars will increase. Okay, so let's start there. So if the demand to to sell AUD by US dollars increases, that demand increases, that exchange rate, the last exchange rate up there will go up or down. Everybody is buying US dollar against AUD, correct? Give people AUDs. They would immediately convert that into US dollars, okay? So the demand to buy US dollars, sell AUDs would increase following our story, right? So this exchange rate basically will go up, okay? So think about the demand side, you don't need to think about supply side. The demand to buy US dollar will go up against the AUD. So that last exchange rate will go up for sure, okay? And what's next? In our story, right? So the next thing we have is to sell USD, buy NZ dollar. So which exchange rate will go up? I think it's better if I just make this thing down there, so you don't need this thing. So buy. So the demand for this thing, right? Correct? Because of our profitable sequence. We know that give people AUDs, they would sell them to buy USDs. So that demand will increase, leading to what? AUD slash USD. So this exchange rate will go. Sorry. Does that make sense? So technically the demand to buy is high. So the value or the price will go up. Okay? And one way to, Well, if you want, you can ignore the AUD, right? So this is all about the USD, the value of the US dollar. The demand to buy will be high. So the price or the value will go up. Correct? Good. Similarly,
And this thing will keep on happening till the arbitrage booking.
yes. So eventually we will have the cross exchange rate or no arbitrage condition to be established. Good. All right. And the next thing in our sequence is what? The demand to sell USD, buy NZ dollar will increase as well. And finally, the demand to sell NZ dollar, buy AUD will also increase. Am I following our sequence? The demand to buy the second currencies, all right, they always increase. So it's very easy to make similar conclusions. So the second thing we know is that the demand to sell US dollar by what? NZ dollar will go up, leading what exchange rate to go up? US dollar slash what? NZ dollar. Okay. And finally, what do we have? The demand to sell NZ dollar by what? AUD increases, leading this exchange rate to increase. Okay. Very consistent. Am I right? Very, very consistent. So as long as people people sell X by Y, the exchange rate X slash Y will go up. Okay, we stay with that point only, and then we roll over. And finally, we compare. So are you happy with these conclusions? Good. The last thing we do is to compare these exchange rates, number 1, number 2, and number 3, with what given to us. Okay. Now I think number 1 is the same thing given to us, right? So let's compare. So in the question, so let me go back to this one. So NZ dollar slash AUD, NZ dollar slash USD, and AUD slash USD. So AUD slash USD, the same, okay? So we know that AUD slash US dollar, that exchange rate will go up, all done, okay? Now the other two, what's next? The next exchange rate is NZ dollar slash AUD. So what do we have? What do we know? NZ dollar slash AUD, fantastic, same, okay? So that exchange rate will also go up. And finally, the exchange rate in the question, NZ dollar slash USD. That exchange rate up or down? So we know that the exchange rate USD slash NZ dollar to increase. But what we want is the opposite, okay? We want NZ dollar slash AUD. Because in the question, it is NZ dollar slash AUD. So what do we say? If this thing goes up, the opposite thing will go down. Good. So the first and the last, you don't need to do anything. But for the second one, you might need to add a little bit, okay? So that NZ dollar slash USD will decrease, okay? Good. All right, so my advice here is to follow the logic in the answer sheet, and we basically do the same, right? If you connect, right? So this one with the first point here, it is actually the same thing. Okay, the demand to sell AUD, buy USD will go up, so that exchange rate will go up. Okay. Second point is this one. The demand to sell USD, buy NZ dollar will go up, so that exchange rate will go up. And finally, the demand to sell NZ dollar, buy AUD will go up, so this exchange rate will go up. We start with all the ups. Okay, we don't focus on the down. All the ups, and then we compare. We compare with the original exchange rates, just to make the consistent conclusion, right? So this thing given to us, so nothing to change. We just take it from here. That thing given to us in the question as well, so we just take the conclusion from here. The only thing not given to us is this guy, okay? Because the question gives us the opposite. So we just make another connection. We say that exchange rate, the opposite exchange rate will go down. That's it, okay? 2 up, 1 down. Question? All good? All right. So that comes, to the last point for today. So all we need for today will be, this is the only thing left. Oh, so by the way, I need to show you our website, all right? So there's something updated from last time. First of all, if you are the best performing student in this unit, you get a prize, okay? Just $500, but that you can have a certificate from the faculty, from the department, and you have $500 in the form of a trading account with the company, okay? They sponsor one prize only, so you need to be the best student for both the assignment and final exam, okay? And we have the T's and C's, the terms and conditions, in this document. So if you want, just open this document and take a look at the terms and conditions, okay? Of course, you don't have to take it. If you win the prize, if you don't like it, we'll give it to the next person, okay? Next ranked person. So, and the idea is that when you receive the prize, okay, you need to open 10 transactions, and after that you can just close the account and forget about the platform, okay? Of course, if you can stay, but the idea is that they want you to trade a little bit before you take out the balance, okay? So if you can make some more money, that's fantastic. If not, that's fine. Just open and close, do 10 trades, and then you can just take out the money, okay? And unfortunately, we can only give one prize. So please work hard if you aim for that prize, and it will happen, okay? The final exam is also important. So we combine the scores for the assignment and the final exam, okay? So the highest grade, the student with the highest grade will receive the prize. Okay, another thing is the live Blackboard collaboration session, the first one has ended, and the recording is available here. If you go to the resources space, you go to Cloud Classrooms, and Blackboard Collaborate Launcher, you can download, you can access the recording. Just go to this menu button, right, and you will see the recordings. Go there and you can download the recordings and you take a look. So we talk briefly, we summarize what we have done so far up to end of week 4 together with the assignment, okay? That is the coverage of the first session. The second session will be in about 4 or 5 weeks time. I'm thinking maybe a few days before the assignment submission, am I right? So that is another opportunity to summarize what we have done so far. And the last one before the final exam. Okay, now this is important. So the assignment discussion during today's Blackboard session, we talk about this thing as well. So we believe that this is very helpful before you start trading. So you are aware of what you need to do, correct? In order to be in a good position with the assignment. Not the final exam, but for the assignment. So in the assignment document, right, we have the marking rubrics and we have 5 criteria, correct? And here we explain what they represent. So there are 5 marking criteria. If you will go to the last page of the assignment document, and right, if you go to the very last page, You will see the marking rubrics, and there are 5 criteria, and your score will be based on this allocation, right? So we will award the points according to this criteria. Right, so take a close look at this, and aim for the last column, high distinction, okay? So make sure that you have excellent management of trading volume, funds, and excellent time management, excellent strategy overall, excellent use of instruments, and so on, okay? Excellent, fantastic, okay? It has to be excellent. That's why we can give you excellent score, okay? So what do we mean by those things? Okay, so this is in more detail, okay? We explain what we mean by those excellent things, right? So the first one, timing of trades. How many days in total have you been trading? So you have to do not answer that question, okay? You have to think about this when you write the report and when you trade, okay? So at the end of the day, you need 12 positions, 12 completed positions. You can do all of those 12 positions in one day, even in 1 hour, correct? But we don't have an opportunity to give you a good score for part B, the report, because what else have you done in the entire 5-week period? We want to see some progress, okay? We want to see an account of the entire 5 weeks period, correct? So if you focus on the trades on 1 day, or 1 hour, part A, that's fine, okay? In part A, we still give you score some, the marks for part A, as long as you have done 12 positions, right? Completed 12 transactions, you will qualify for part A's ranking scheme. But for part B, we can't do anything, right? Because we want to see a lot, and you have nothing to show. 1 hour, 5 weeks, a lot of hours, right? So a lot of opportunities to do a lot of things, and you ignore them all. So we cannot give you a good score. So think about it. We don't have a unique formula. How many days is good, but as a rule of thumb, right? Maybe a few transactions this week, right? 4, 5, I don't know. It doesn't have to be 4, 5. Could be 3, could be 10. Maybe a few more next week, and a few the week after, something like that, am I? And then spend the last 2 weeks, or maybe the last week, to polish the report. The report you should write as you trade, because otherwise you will forget completely why you have those positions, all right? So write the report the same time you trade. So it's one good way to go. Okay, so and don't ask me how many days do I need to trade. No answer, okay? It's up to you, all right? And some people are very busy, some have a lot of time, okay? In the past, some students did 100 trades, but the whole class, many people did the minimum, okay? 12 positions because they were busy. That's fine, okay? No difference. The quality is what matters, all right? The quality is the analysis. We don't care. Well, of course, if you trade a lot, we might have some positive thinking, okay? Work hard, okay? Deserve some more credits, okay? But not too much. Of course, if you trade more, that is going to give very good impression, okay? Don't think that 12 is 12, okay? You can do more. You can do 20, 30, okay? And then that is one way to give impressions that you work hard, okay? So don't just keep my words as 12 is exactly 12, okay? So it can be more than 12. And no unique formula, how many days, how many trades, is up to you, okay? If you are free, you have some time, why not open more trades, okay? If you are busy, keep in mind the minimum requirement, okay? And keep in mind that we want to see a big picture. Don't just put everything in 1 day or even 1 week, okay? Because you have a little bit more than 5 weeks. Mixed up instruments. Have you done day trading, limit orders, and forward transactions? We want to see a mix of these things. Clearly stated in the trading slides, we want to see a mix of these things. And how much do you need to mix? It's up to you, okay? Of course, there will be a lot of day trading positions, I know, but some forward positions, some limit orders, okay, some efforts. Limit orders, they are reserve orders. They don't have to be captured, okay? Don't worry if nothing is going to be captured. Just because we can sell, we will log in to check the account, we will see your effort, okay, in using limit orders. Number of currencies, same. If you trade only AUD/USD, it's not too bad, but it's not good either, okay? We cannot give you good credit for that because there are so many opportunities, right? So many currencies, different currencies. So why did you just focus on one exchange rate pair, right? Having said that, don't show that you've done 10 currencies, okay? That's too much, way too much. Why? Because you have only 4 or 5 weeks, 5 weeks. You don't have time to do a good research on 10 currencies. Come on, right? 5 weeks is short, okay? One currency already takes you many days. Right? So don't try, 10 or 12 different currencies. That's way too much, okay? But one exchange rate pair, meaning 2 currency, 2 or 3, I don't think it's good either, okay? So how much is the best? I don't know. It's up to you. Maybe 5, 6, 4, I don't know, okay? So you decide. But don't waste time trading a lot of different currencies because you have to do a lot of research, and that's what we don't like. Fund allocation, okay? Did you put $10,000 in one position? What is the explanation? Okay, you cannot risk a lot of money that way, okay? Because you have $50,000 and you need 12 positions. You need to protect the position, am I right? So you cannot put $10,000 or $20,000 for one trade. It's very difficult to justify, right? You're not going to work for the company for one day, right? You work for the entire year. So you should have a good allocation. And how much is good allocation? I don't know, but $1,000 or $2,000 per trade as a margin to risk should be good to start with. Eventually, when you're comfortable, you can increase a bit, okay? But don't make it $20,000 for one trade, especially risky thing like gold. It will be gone quickly, okay? It will be gone quickly. So don't do that. Is that okay? Good. Now you do that for part A, that's fine. Okay, we don't care that much about what you did. As long as you have 12 completed positions, you will qualify for the ranking. You might end up with a good score for part A, but no guarantee for part B if you do that, okay? And risky trades, have you done some gold, oil, or index trading? It's completely fine, okay? As long as you have explained in the report why you did so, okay? You cannot trade without explaining. So if you have some gold position, make sure that in the report you cover those positions in certain ways, okay? Explain why you have those positions, okay? What opportunities that you have observed, okay? No mark bonus, no deduction, unless you just ignore those positions in the report. We will deduct the marks because you trade without explaining. Okay, so clearly an opportunity to deduct marks. And too many unexpected losses, many will end up with this unwanted outcome. It's completely fine. Okay, don't worry, because from our experience, the final balance would sit on average at around $43,000. Okay, 43,000 Australian dollars. Or 42 something, okay? That is from our experience in the past, based on the students who did this unit before. So if you end up with around 40, don't worry, it's normal, okay? It's normal to lose money, but if you lose everything, that's different, right? Well, even if you lose everything, that's fine, but you need to give stories for losing money, okay? Losing money, and what lessons you have learned, am I right? Okay, is that clear for the first criteria? Okay, so now you know what to do, correct? So you spread the trade in a certain way, have a good mix of instruments, currencies, and so on. Now, the use of theoretical tools. Apply the theory, you don't need to explain the theory, just apply the theory in certain contexts. Okay, for example, RBA's cash rate decision, right? Or tonight, the budget night, is that now? Still a little bit time, okay? So we might want to listen to what happens in Australia between now and next year, okay? They have the budget night tonight, starting from around 7:30 p.m. on many television channels. You might want to listen to that if you are interested in the AUD, Okay, so if you use some graphs from the lecture slides or the textbook, the same. You don't have to draw this graph because it takes a lot of time. Am I right? Just cite the graph in certain way. So my argument is based on lecture slide number 17, topic 2, part 3, something like that. That will work. Okay, you don't have to draw the figure. It takes a lot of time. Okay, so just cite the figures if you need to. Now, technical analysis, there's no need to use TA in this unit, but if you know how to do it, just go ahead, provided that you explain. And the use of technical analysis is to support the fundamental analysis only, okay? Just keep that in mind. We need to see the stories based on the fundamentals, economic fundamentals, not, charts, trends, and so on. But having said that, you can use those techniques to support the positions. For example, the moment you open the trade, right? If you want to buy AUD, it doesn't mean that you have to buy immediately. You might want to wait a bit, okay? Because the chart is trending down, for example, am I right? You can explain that because the chart is trending down. You can produce a simple chart, and then you say because of that I wait a bit, and I pick up AUD at a good price, something like that, am I right? So the use of TA is in that environment only. Don't just rely on TA. Okay, you can do some, but not focus. The focus is on FA. Now the next criteria: research and external sources. Have you done a comprehensive research? Go to the search portals and put in a lot of information. Right, AUD, USD, budget night, interest rate in Australia, RBA, whatever. Am I right? Chinese money demand, whatever. Okay. So and then not download, but take a look at the references, especially the news articles. Okay, you don't have to copy those news articles in the report. Okay, just put the link in the reference and also size up in the text. That should be enough. Have you missed some important events, news? If you trade AUD, did you ignore the cash rate decision today? That would be a bit unusual. Okay, that's a very important thing to monitor. Have you tried to justify transactions according to news and events? Okay, did you link what you did with what you research? That is what we want to see. So if you can establish a strong link, we'll give you very good credit. Okay. And the last two, risk management, risk control, and management. The use of take profit and stop loss functions. Please, when you open a position, go to edit or modify the position and change the stop loss and take profit regularly. Okay, that way you don't have to stay in the market. Okay, the market can do everything for you. Am I right? So stop loss is connected to the amount of risk. You can't do anything, but you can adjust it. You can add a little bit more money. You can take out some more money if you think that you put in too much. Okay. But take profit, don't aim for $1 million. It will never happen. Okay, if you buy AUD, set take profit, skyrocket, it will never happen. Okay, so be realistic, pragmatic. Am I right? Well, as a rule of thumb, if the stop loss is going to be on the other side of the coin, 1% down, you are gone. Then take profit maybe set something like 1% or maybe 0.5%. Aim a little bit less. Am I right? And I can, it's not, you can't be rich after one night, right? It is a good effort at the end of the day. Okay. Justify how you have used those tools. Now options is not required, but if you know how to trade options, go ahead. Okay, go ahead. But focus on currencies again, and you need to explain. Okay, you are allowed to do anything that you observe, but you need to explain in the report. Okay, no mark deduction, no bonus of course. And finally, presentation. Please make sure that you follow the instructions. Right? The cover set, executive summary, appendix, citations. So they are the fundamental thing. And 20, analysis. The link between transactions and the theory, because that is important. Make sure that they are transparent and the message is strong. And finally, expression of ideas. Pay some attention to this one because that can change a lot of things. Okay, so writing, presenting ideas It's not easy, okay? You have to practice again and again. Sometimes you need to spend time to polish what you have typed, and again. So that's my advice, because I do research as my profession, and this is a normal thing, you know? Sometimes I need to change a draft more than 10 times. That's normal, okay? Keep changing, updating, improving. It's normal. Of course, having said that, don't do it if you don't have the time, okay? So we don't want students to waste too much time on this exercise, right? You have to balance between this unit and other units, right, for the trimester, and also work and life. But at the end of the day, take these points into consideration when you trade and write the report, okay? Questions? All good? Okay, so thanks for coming. I see you again next time.